Hey everyone, me Kevin here. This is so exciting and such an honor coming to you from the New York Stock Exchange. We've got trading booths behind me. We've got CNBC right here. There is the bell that we're going to ring for the closing. Such an honor. Presidents have been up there, celebrities. This is so cool. And today we get to ring the closing bell. This is Jim Cramer's CNBC Mad Money set. When he films on the floor, they bring out the buttons. I really wanted to push the buttons, but he keeps those under lock and key because those are special buttons. But in this video, we're going to talk about expectations for how CPI Tuesday could affect a pricing power play, because that is why we're at the New York Stock Exchange. We believe there could be an opportunity now to make bets on pricing power. Y'all know that I'm a licensed financial advisor, but this video is not personalized financial advice. It's all about pricing power. So let's think about this. On Tuesday at 5:30 a.m., we have the potential for reiterating what we had in the last CPI report, exceeding what we had in the last CPI report, or going right back to the disaster we've had over the last 6 months. We thought the bottom of the market was somewhere in the summer. That didn't happen. We are still dragging an anchor along the bottom of the market. And pricing power will get substantially affected by this CPI report. Here are the expectations. So in November, we got the October CPI that came in well below what Bloomberg analysts were expecting. So here's the lay of the land. Tuesday the 13th at 5:30 a.m., we're going to get a CPI report. This CPI report is either going to reiterate the downtrend that we have and hopefully more of a downtrend than what analysts are expecting. Remember the last CPI report that actually started a rally and started Jerome Powell calming down. Jerome Powell stepping back on his aggressiveness because he realized the lagging effects of monetary policy are starting to hit. The more lagging effects of monetary policy start being realized by the Fed, the less pressure, the lower the potential terminal rate for the Fed. The lower that potential terminal rate, the more likely pricing power stocks, I believe, no guarantees, do well. This Tuesday is so critical because it's the second CPI report that could reaffirm falling inflation in a row. That's so important because every time we've had a report previously, what have we been told? We've been told it's just one report. It's a one-off. One report doesn't make a trend. This Tuesday is so critical. And when we talked with Peter on the floor of this trading floor, we know that when reports come out, they are volatile. It is like watching the Super Bowl here at the exchange. And this would be the place to be for CPI. But as individuals who are investing and thinking about our personal portfolios, what are the expectations for CPI on Tuesday and how could they affect the market? So last month, we had 7.7 and 0.4 on the month over month. That 0.4 came in below expectations. That's 4.8% annualized. What are we expecting this time? Well, this time on the 13th, we have lower expectations, which would be good if we just met them. We are expecting on the survey 0.3% on the month over month. 0.3% on the month over month would bring us to 3.6% annualized. In my opinion, if we could just meet that expectation, we could really see pricing power stocks do extremely well. Of course, no guarantees. In fact, some might say if we get a low CPI read below expectations here on Tuesday, we could see the beginning of a Santa Claus rally. I'd like to see more Santa Claus here. I've seen snowmen here, but I think after the 13th, we might see some more blow-up Santa Clauses come around the exchange, which would be pretty cool. So, on the year-over-year CPI, we're expecting 7.3%, down from the 7.7 last time. Again, I want to reiterate that if we just meet expectations, we will affirm the downtrend we're looking for. And I believe we could go into an end-of-the-year rally for tech and pricing power style stocks. The biggest danger we have is if we miss expectations to the upside, we will hurt the downtrend. We will remove the second report in a row of affirming disinflation. When we remove that, we'll give more ammunition to the Federal Reserve and Jerome Powell to say, look, we still don't have a downtrend in inflation. We still have wages rotating up. Just yesterday, we again saw the job changers' wage gains rotate up. This is not what we want to see. Just this morning, we had a PPI, producer price, the seller side release. And what happened? It was mixed. It was a mixed bag. Sure, some parts we can look at came in low, but other parts came in high. And this is a problem. When we see services continue to press prices up, those could trickle through to goods and other service prices in CPI. Now, I am personally hopeful that in this CPI, we are going to see a consumer-driven report. That is, hopefully companies aren't pricing through all of those PPI gains we saw, leading inflationary prices to continue to move up. We want to see consumers keeping a lid on those. How do we see consumers keeping a lid on prices? We see them not buy as much. We see inventories go up. Even a company that has extreme pricing power, that doesn't reduce its prices, like Lululemon, saw inventory tick up today, or in their earnings report yesterday. That's not necessarily a bad thing, though, because in my opinion, the companies that I personally am looking at, again, not financial advice for you, even though I'm a licensed financial advisor, it's not personal advice. I believe we want to go into 2023 looking for companies that are going to have the fewest EPS downgrades. There are two phases in a market downturn. Phase number one is multiple compression. This is when price to earnings multiples get written down in anticipation of either high inflation or requiring higher discount rates, which basically pushes stocks down. Give you a quick example. Stock sells for 25 times earnings. It has $4 in annual EPS. It sells for $100 a share. Very simple. If that now trades for $12.50 times as a multiple, the stock halves. Goes from $100 to 4 times 12.5, which is then 50. But what if that $4 goes to $2 because you have an EPS downgrade? Well, now you risk that $50 stock that was at 100 now going to 25. That's the second phase of a recession, is when you get EPS downgrades. And this is exactly why we're focused on pricing power. And that's why we're at the New York Stock Exchange to talk pricing power. Because pricing power stocks are companies that may have gone through multiple downgrades. You may have seen pricing multiples already get adjusted down. You look at Amazon, Meta, Apple, Tesla. These stocks across the board, technology stocks down 50, 55%. These are our multiple downgrades. Now, you want to do your best, in my opinion, to stay away from the next phase of the down cycle. And that's staying away from companies that are going to revise EPS down or miss substantially on EPS. The companies that miss on EPS are companies that have to drop prices without being able to sustain high margins. See, just dropping prices does not mean you don't have pricing power. Think about that for a moment. If you drop prices, but your input costs plummet, you could actually grow and expand margins and have more pricing power overall with your margins, how much you're bringing from price down to net, by investing in companies that have that capability. For example, we strongly believe that Tesla has very strong pricing power. The reason we believe that is as they renegotiate their contracts, we believe their trade contracts, their commodity contracts, we believe they're going to be able to increase margins while lowering prices. That to us is a company with pricing power. Lululemon is a company with pricing power, in our opinion. You look at NVIDIA. They design chips, but they don't manufacture them. Who manufactures them? Taiwan Semiconductors. Both of these companies, though, pricing power. Why? Taiwan Semiconductors taking over a lot of chip production for a company like Apple, another company with extremely high margins on their products, and they're doing so to move production to America. That's a sign Taiwan Semiconductors has pricing power when they get contracts from companies like Apple. And those are the sorts of plays we're looking for. But we're also wanting to be cognizant of issues like macro. When we look at a company like Enphase or SolarEdge and we see, wow, massive margins on batteries, what happens when lithium costs go up? How much is that actually impacting these battery margins? On top of that, what happens when residential fixed investment declines and we start seeing housing prices decline? Is there the potential that we're going to see less people investing in solar panels, less people investing in inverters for their homes or batteries for their homes because they decide, you know what, we just have less available cash? Remember, JP Morgan expects consumer excess cash will go to zero by the middle of 2023. That is going to hurt a lot of companies that I believe are price takers. Price takers, in my opinion, and it's not to bag on any stocks, but I believe price takers are companies that appeal to the regular, everyday consumer. Grocery stores, the Walmart, the Target, the staples. There will be a race to the bottom, I believe, in these. We'll see premium brands move to white label brands, move to discount brands. This is how we know margins will come down at companies that manufacture these products. Remember, you go buy, let's just say Planters nuts, that's a premium product. You go move to the discount version, it's still Planters, but Often it's still planters, but it's at a lower margin. The companies that sell this product, I believe, will end up with less pricing power via lower margins because they have to reduce prices. Certainly, we expect to see that happen in autos, in clothing. We've already seen it happen in PCs. We actually think PCs might be at the bottom. And that this CPI read, if we can get an optimistic read this season, this report, the November report, which is going to encompass the seasonal adjustments for Black Friday and Cyber Monday, if we can get this report to come in optimistically and set a trend of 2 positive CPI reports in a row, we know what happens next. When CPI trends down, PPI is going to roll over. PPI will roll over, services will roll over, wages will roll over. And this is something that's very interesting. People say that unemployment takes the escalator down and the elevator up. The first shoe to drop is CPI, then PPI drops, then unemployment goes up. And so this Tuesday at 5:30 a.m., I will be live streaming the report. I invite you there. I invite you to think about your pricing power strategies and invite you to be ready for what could be the start of our Santa Claus rally. Unfortunately, if we get a bad read, all bets are off and we'll have to be a whole lot more patient because then we could be dealing with pricing in a whole lot more aggressive Federal Reserve's terminal rate. Right now, expectations are around 5.2. Could go as high as 5.5. Some folks say we might be ready to price in a 6% terminal rate if we get a bad CPI read this time, because it will, again, break the downtrend. And we don't want to break the downtrend. If we could just meet expectations, we're sitting pretty. So good luck, everyone. Thank you so much for watching. Look at the New York Stock Exchange. I'm so excited and honored to be here. I cannot wait to ring the bell. It's December 9th, which also means there's a coupon code. PP is the code expiring today. Check that out in the links down below for the courses on building your wealth, and we'll see you in the next one. Thanks. Bye.